If you look away for even a second, you might miss the quiet shift happening right now that could completely change how this entire market moves. Silver just printed 77.425 overnight. No warning, no gradual climb, just a sharp move that caught most people off guard. And if you think this is just another volatile spike, you might be missing what's actually happening underneath the surface. Because here's the part no one explains. Price doesn't move like that in a vacuum. When silver jumps aggressively in a compressed window, something behind the scenes is shifting. Liquidity, positioning, supply expectations, or stress. You're probably seeing headlines about inflation fears or dollar weakness. That's the easy explanation, the kind that fits neatly into a news ticker. But this is where it gets interesting. Silver doesn't just react to inflation. It reacts to instability in the system that prices it, and that system is heavily leveraged. Most people see the spot price and assume it reflects physical scarcity, bars, coins, vaults. But what you're actually looking at is a futures-driven reference price shaped by contracts that can represent far more silver than physically exists in deliverable form at any given time. Let that sink in. When silver explodes higher overnight, it often means paper positioning got squeezed, short exposure forced to unwind, margin pressure building, algorithms accelerating momentum. But here's the twist. Sometimes those squeezes reveal something deeper than just bad bets. They reveal imbalance. And that's not even the worst part. Because when price spikes rapidly, it can mean one of two things. Either new demand overwhelms supply, or existing supply was never as available as assumed. And those are very different realities. You see, the silver market operates on confidence. Confidence that futures contracts can be rolled, settled, or delivered smoothly. Confidence that warehouse inventories are adequate. Confidence that liquidity will absorb stress. But here's the part. No one explains. Confidence is invisible until it cracks. Silver hitting 77.425 overnight forces participants to reassess risk models. Clearinghouses raise margin requirements. Volatility estimates jump. And traders who thought they understood the range suddenly find themselves outside it. This is where it gets disturbing, because sharp upward moves aren't always bullish signals. Sometimes they're stress signals. When a market reprices quickly, it suggests something was mispriced before. The question is what? Is it industrial demand outpacing expectations? Is it geopolitical tension feeding safe haven flows? Or is it something more mechanical, like concentrated short positions being forced out of the trade? Here's what most people miss. Silver is both an industrial metal and a monetary asset. That dual identity creates friction. When economic optimism rises, industrial demand supports it. When fear rises, monetary demand supports it. But when both pressures collide at once, the price response can be violent. And that's not even the worst part, because rapid upside moves also expose structural fragility in the paper market. If too many participants were positioned the wrong way, liquidity dries up fast, bids thin out, offers disappear, price gaps. And you don't see that on a simple daily chart. You just see a number that looks exciting. But here's the contradiction. If silver is truly breaking out due to strong fundamentals, why does the move feel unstable? Why does it come overnight instead of building gradually? That's the question no one wants to answer. Because overnight, repricing suggests surprise. And surprise suggests something wasn't fully understood, either by traders or by the system itself. Let's slow this down. In futures markets, leverage amplifies everything. A small imbalance can create an outsized move. But when leverage is widespread and positioning is crowded, even a moderate catalyst can trigger a cascade. And silver has a history of cascades. You've seen it before. Rapid rallies, sudden crashes, extreme volatility. But here's the part no one explains. Each cycle leaves behind structural adjustments. Margin rules change, position limits tighten, risk tolerance shrinks. And when silver prints 77.425 overnight, those adjustments start being discussed again behind closed doors. This is where it gets unsettling. Because if price is rising due to genuine physical tightness, that suggests supply constraints. But if it's rising due to paper market stress, that suggests liquidity constraints. Either way, constraints are forming, and constraints mean something is reaching a limit. Now ask yourself this. If silver's price had been artificially compressed by heavy short exposure or excessive synthetic supply, what would happen when that pressure finally releases? It wouldn't look orderly. It would look like what you just saw, but here's the part no one explains. Price spikes don't confirm a new equilibrium. They expose the old one as unstable. The market then has to decide whether this new level is sustainable or just a temporary overshoot. And that decision happens quietly. While headlines celebrate the breakout, institutions reassess collateral. Risk managers recalculate exposure. Industrial buyers reconsider procurement timing. Because at 77.4 and 25, silver isn't just a commodity. It's a variable in hundreds of corporate models. And that's not even the worst part. Because if the move is tied to delivery stress, real or perceived, it can change behavior. Participants who normally roll contracts might stand for delivery. Buyers who trusted paper exposure might demand physical allocation. And if that shift accelerates, the paper to physical ratio becomes more relevant than ever. You don't hear much about that ratio on mainstream platforms, but it's critical. The number of outstanding claims versus available deliverable metal. It doesn't need to collapse to create stress. It just needs to tighten. This is where it gets disturbing. Because tightening doesn't announce itself with sirens. It shows up in small anomalies, wider spreads, higher premiums, slower settlement, incentives to roll positions forward. Each one by itself looks manageable. Together, they suggest pressure, but here's the twist. What if this spike isn't about silver alone? What if it's about the broader financial environment? Rising debt loads, currency volatility, global uncertainty. In that context, silver becomes a signal, not just a trade. When confidence in monetary stability wavers, hard assets react. Sometimes slowly, sometimes violently. And when they move violently, it can indicate that risk perceptions shifted faster than policymakers expected. And that's not even the worst part, because rapid appreciation also draws speculative capital. Momentum traders pile in, retail interest surges, social media amplifies the narrative, and suddenly, price action feeds on itself. But speculative flows are unstable. If this move is fueled partly by short covering and partly by momentum chasing, sustainability becomes questionable. Volatility remains elevated, swings widen. So is 77.425 an opportunity, or is it a warning? That depends on what's driving it. If it's rooted in structural supply deficits and long-term demand strength, the move could mark a repricing phase, a shift in how silver is valued relative to currencies and other assets. But if it's rooted in mechanical stress and leverage unwinding, it could signal fragility, a market forced higher not by strength but by imbalance. Here's what most people overlook. Both scenarios point to instability. Either silver was undervalued and is correcting abruptly, or the market structure was overstretched and snapped temporarily. In both cases, something wasn't aligned, and misalignment doesn't resolve quietly. This is where it gets uncomfortable. Because silver's volatility often precedes broader conversations about liquidity, about leverage, about systemic risk. It's smaller than gold, thinner, more reactive. It tends to amplify shifts that gold absorbs more smoothly. So when silver moves like this, experienced traders don't just celebrate, because markets under stress can appear strongest right before adjustments. Parabolic moves feel empowering, but they can also mask vulnerability. If price overshoots due to panic covering, it may retrace sharply. If it's signaling deeper supply issues, follow-through may come, but with turbulence. Either way, stability is not the immediate outcome. Now connect the dots. A futures-driven pricing system, leverage embedded in positioning, industrial and monetary demand intersecting, warehouse inventories fluctuating, confidence underpinning delivery mechanisms, and an overnight spike to 77.425 that forces everyone to recalibrate. That's not random, it's a convergence. For the broader market, it suggests repricing of risk. For institutions, it signals volatility in collateral values. For investors, it raises questions about whether price signals are reflecting fundamentals or structural strain. But here's the part no one explains. The real story isn't the number itself. It's what the number reveals about hidden pressure. If silver needed a sudden move to clear imbalances, that tells you the prior equilibrium was artificial. If it needed a squeeze to break free, that tells you leverage was heavy. And heavy leverage doesn't disappear overnight. It adjusts, sometimes violently. So what does this actually mean? It means the silver market just exposed stress lines that were previously invisible. It means pricing mechanisms are reacting faster than narratives can catch up. It means volatility isn't noise, it's information. And for you, it means understanding that sharp moves aren't just opportunities to celebrate or fear. They're signals. Signals that something underneath shifted. The public sees a breakout. The system sees recalibration. If confidence remains intact, the market stabilizes at new levels. If confidence weakens, volatility persists. Either outcome reflects pressure being processed in real time. Silver at 77.425 overnight isn't just a headline. It's a message about leverage, liquidity, and latent imbalance. Now you see what most people don't.